You don't need to know all of the patterns that are out there, you see. But as far as I'm concerned, and with all my experience and the time I have spent in Forex, the two patterns that are mentioned below, which is the engulfing pattern and the morning and evening stars. These two patterns, they are very important and they make a huge difference. Price usually follow through once these two patterns have been formed on the chart, right? So we've got the engulfing pattern, which comes in two ways. It's either a bullish engulfing or a bearish engulfing. And then we have a morning star and an evening star. So these two patterns, they are very important. So what is engulfing pattern? So when a strong area of supply or demand is engulfed, it often signifies a change in market direction. The base that forms before the engulfing pattern, often in most cases, becomes the focal point that a trend change, its bias or direction. So this area is going to represent a very high probability setup. It means from this area that has been engulfed, there's going to be a whole lot of chance for you to trade from that area. So on the chart below, you can see I've got an illustration. I'll show you using the chart, like the MT4 chart, but for now, I'm going to illustrate to you what an engulfing pattern is. So for instance, we've got a demand level at the bottom here. Can you hear me?
Yes.
Right. We've got a demand zone illustrated. So price has been ranging, and then massively moves away. That creates a demand zone. Correct, right?
Yes.
Now, when price comes back after creating a new level of supply up here, when price comes back to this demand zone, you can see price massively rallies through and then it engulfs this whole area. There's no like price meandering here, right? It just engulfs the whole area, right? The price completely engulfs the demand level. Now what this does is when price comes back to the fresh level of supply, this one here, the one that was created here, the level will provide a high probability short setup. It means when price comes back here, after doing this, when price comes back here, you look to be a what? A seller. So we've got two reference points that we have used. This is a demand level, right? Price massively rallies away. When it finds resistance, it creates a new level of supply and massively drops back to the demand. But now the demand is engulfed. There's no consolidation, there's no ranging or anything. Price just rallies through and close below. When it comes back up here to the new supply zone that was created, you need to be hunting for short trades. So in most cases, when a level is engulfed, price usually continues to the next level. As shown here on the graph on your left, you will find that this occurrence is common in the market. This is way too common, but most people, they don't understand what engulfing is and they don't take note of the price action to the left of the chart. They just look at the current price action and they don't give reference to the price action on the left. So the opposite applies for so this is a bearish engulfing because price is dropping to the downside. So you'll be having big-bodied candles to the downside. If it's to the upside, it will be a big bullish candle that engulfs a supply level. You see? So it will be a candle that engulfs a supply zone. So it will be something like this. So that when price comes back here, you look to be a what? A buyer. You see? So the opposite applies when it comes to the bullish engulfing. Now, regarding a MorningStar, a MorningStar is mainly viewed as a bullish reversal pattern, right? A bullish reversal pattern, it means you are going to be looking for long trades. So that means it happens normally at a demand zone, at a support zone, or when the market is oversold. That's when you see a bullish reversal pattern. And in this case, we are talking of the MorningStar. So it usually forms at the bottom of a downtrend. A MorningStar pattern is comprised of 3 candles. Number 1, you are going to see a strong bearish candle to the downside. You can see with the illustration there, candlestick number 1. So it's a 3 candle pattern. It has to have those 3 candles. So the first candle is a strong full-bodied bearish candle, which is then followed by a small bullish or a bearish doji, which is then followed by a strong full-bodied candle to the upside. Once you see candle number 3 forming, in most cases, make sure it's happening on a daily chart. Don't use candlestick patterns on lower time frame. They might not be respected. But if it's on a daily chart or a weekly chart, then they will be respected. So you see we've got our MorningStar here, which is a combination of 1 full body bearish candle. A MorningStar, it's a full body bearish candle. Then we have candle number 2, which is either a bearish doji or a bullish doji. That's a candlestick type. Then followed by candlestick number 3, which is a big-bodied bullish candle to the upside. It means on the following day, the 4th day after this pattern is formed, if this price action is happening at a strong demand area, you need to be a buyer on the 4th day. It means you are hunting for long trades. Yes, that's for a MorningStar. Then for an evening star, it's the opposite, right? An evening star, on the other hand, is a bearish reversal pattern, which usually occurs at the top of an uptrend. That means when you are looking at a market that is oversold, or when you are looking at a market which is approaching a strong area of supply, then you need to be hunting for an evening star. It's not a case of hunting. You just have to read the price action, like the candlestick formations that are happening. So an evening star, on the other hand, is a bearish reversal pattern, which usually occur at the top of an uptrend. Likewise, it also comprises of 3 candles: a strong bullish candle, which is number 1. We've got a strong bullish candle as we approach a supply zone. You can see my supply zone highlighted in gray there, followed by a small bullish or a bearish candle, which will either be a doji. You can see candle number 2. Candle number 2, it has to be a small bodied candle. Then candle number 3 it has to be a big bearish candle, a large bearish candle that moves away from the what? From the supply zone.
Right.
You see, once you have seen that pattern, the following day you need to be a what? A seller. Because
Seller.
there's clear confirmation that price has reversed from a what? A supply zone. Now, the other thing, when you see an evening star, it can happen that you don't recognize it when the price action happens. But after like 4 or 5 days later, then you see that, oh, I've got a morning star here at a strong area of what? Of supply. Once you see price coming back, see here, once you see price coming back now to your morning star pattern, then you need to be a what?
Seller.
A seller. Same applies on the morning star, right? On the morning star, I said this market had rallied away and you'd have missed the chance to trade long. When price comes back here, where the morning star formed, you need to be a buyer because the chances for a market to rally to the upside, they are what? They are very strong.
Very strong. Okay.
Yeah. So these two patterns, the engulfing pattern, which I'm going to show you now on the chart, because I've already shown you the morning star and the evening star. I'm going to show you on the chart in a moment what a engulfed supply zone looks like and what an engulfed demand zone looks like. So these two patterns, the engulfing pattern, the morning and the evening star, they are very powerful when they happen or when they form at a critical area of demand or supply. So it's not a case that when market is in the middle of the trend, then you start looking for an evening star. No, it's not going to work. Firstly, have the condition of market being at a higher time frame supply zone. Then you've got a better chance of seeing an evening star. Or let's say market is at a higher time frame demand zone. You've got a better chance of having a morning star candlestick formation at a higher time frame demand zone. So now I'm going to illustrate. Okay, before we go to the illustration of engulfing pattern of supply zone or demand zone, let's talk about proximal and distal lines quickly because they are part of the demand and supply zones. So proximal and distal lines, the base of any supply, right, and demand is defined by a proximal line, which is the lower line, and a distal line, which is the upper line. So you've got your supply zone here. This is for illustration, right? You've got your supply zone. So this line here, the lower line, this is what we call the proximal line on a supply. On a supply, the upper line, we call it the distal line, right? And when we talk of demand, right, we've got our demand there, right? The opposite applies. So this line here becomes your proximal, and this one your distal. You see, that's for a demand. But now we are talking of a supply. The distal line will be the price further away from the current market price. The proximal line will be the closest to the current price action. When drawing supply, always cover the highest high. Remember what we talked about, I think in the second class or third class, I can't remember. Always cover the highest high in the base area or the peak, which is the swing high. When drawing demand, always cover the lowest lows in the base area, that is your swing low. This is of huge importance. It's paramount that you master that. That is, remember when we were drawing the levels, when I say you highlight the lowest of the two candles, the one that rallies away, and the last, say, down candle in case of a demand. In case of a supply, the last up candle, you highlight the highest high between the two candles, the one that massively moves away, and the last up candle. So for a demand, Proxima and discount lines illustration on a demand. So we've got our price at 12.74. This is gold. So we've got a demand area here. You see, this is our last down candle. Of course, we've got this then down candle here. You see this one here, but it doesn't close below this one. So that makes the previous candle our last down close candle. Then we've got this one that massively moves away, the green candle here. That creates our demand, right? So the lowest low between this candle and the last down candle is here, right? That lowest low now defines our distal line. And then where this last down candle opened means that's where it was broken above with the impulsive move. That's where our proximal line is drawn. We are going to draw this again on the chart shortly. Right, so proximal and distal lines on a supply level. You can see we've got our supply level highlighted there. This is our last up candle. Remember, for a supply, for you to draw a supply, you need to highlight the last up candle and the candle that massively moves away from the zone, right, to define your supply. So we've got the highest high that is going to define our distal line, and then the price point where price breaks to the downside of the last up candle. That's where your proximal line is drawn. I hope you have understood this. I'm gonna send you the notes. Yeah, I'm gonna send you the notes once we are done. So now we are going to go on to the chart, the MT4. And then I'm gonna show you firstly the engulfing pattern, and then I'll show you how to illustrate the distal and the proximal lines on a supply or on a demand zone. So now, when we say how then do we illustrate a demand zone or a supply zone that has been engulfed, right? But firstly, you need to be in a position to have highlighted the zone. Like for instance, this is what pair is this? This is Euro GBP. You can clearly see on the chart. You see this candle here. Let me grab my tool so that I can use the drawing tool. You see this candle?
Okay.
Right. That candle here, prior to all this other price action to the right of it, prior to that happening, that was the last up candle from here. This is our last up candle. Okay. That's correct, right? Now,
yes.
I'm going to mark the opening price and extend my line. Then I'm going to mark the highest high between this is the candle that massively moves away, the following bearish candle. So our high is up there. Yeah, of course, this range is going to be a bit high, you see, because the wick is too large. But what I'm trying to illustrate is that this area here, right, this area would have been an area where you look for shorting opportunities when price came back, right? This would have been an area where you'd have been hunting for sell trades because of this supply zone. That's correct, right?
Yes, yes.
Now, once price broke above, let me put back the lines. I'm not going to use the wick now because the range is going to be a bit big. Once it is broken above, can you see this candle here?
Yes, yes.
Right. The way this candle massively engulfs these two levels, that's what we call a bullish engulf, because it has engulfed the whole supply area, meaning this level no longer works as a what? Is a supply.
Supply. Yeah.
It's no longer a supply zone because it has been violated, right? Market has taken out all the sellers that were here. They've been taken out. So it means the buyers are what? Are in control, right?
Okay.
Now, basics of supply and demand. This move up here, when price comes back, we look to be a what?
A buyer.
A buyer. From the engulfing candle. And you can see that's exactly what happened. Market came back into this area here, the candle that engulfed this supply zone and this supply zone. Market traded away, but when it came back, there you'd have been a buyer to the upside.
Upside, okay.
You see, you'd have been a buyer. So this illustration is for a bullish engulfing. I'm gonna try to look for another chart which can show us a bearish engulf. Let me see, Euro USD. Do we have a daily chart? Nope, there's no setup there for a bearish engulf. Euro GBP CHF. I'm just trying to see if I can get a bearish engulfing on right. I think we've got one here. I think we've got one here. Let me go to a daily. Right. So this is what British pound. So here on GBP USD, let me go to my daily time frame. Zoom in. Right. You can clearly see we've got a demand level that was formed here. Right. Price rallied away. Then when it came back, it offered, this is a daily chart by the way, it offered you a whole couple of times to trade long. You see, every retracement I'm doing there is a chance for you to jump in on the trade and trade to the upside. So we've got a demand zone here, probably on a lower time frame. Now let me clear up. Right. I'm gonna highlight the demand zone. Let me go to a lower time frame. We're on H3. Let's go to H4 and zoom out a bit. Right, this is where the demand was created. But I wanted to show you on daily, because on daily it's much clearer. Right. Let me just highlight this area here. Right, so I've got my demand highlighted. Of course, it's not going to be perfect because this is just illustration purposes. So it might not be perfect to the peep. So now we had market rallying away from the demand, coming back, trading higher, coming back, trading all the way high. Then when it finally came back, probably for the fifth or sixth time, you see this big bearish candle to the downside.
Yes.
That's what we call a bearish engulfing of a demand area. It means this area here has been engulfed by one candle, meaning
Okay.
meaning all the buyers that were here, they've been absorbed now with the market. The sellers are now in what? In control.
Control. Okay.
Yeah. So when price, remember this is a daily chart. So if we go to an hourly chart, this retracement back into this candle here offered great opportunity to short the market. Even if you had missed the first retracement, look what happened to the second one here.
Second one.
It came back into this area
Into the zone.
and then it traded all the way to the downside. You see? So that's a bearish engulfing of a demand zone. So you'll be looking to be a what? A seller when price comes back. When price comes back to the candle where it engulfed the what? The demand zone. Yeah. So you'll be a what? A seller here because you already know that the market has changed the structure. Market structure has changed here. So when price comes back, you look to be a seller. And the opposite applies for a demand that has been, or a supply zone that has been engulfed, which is a bullish engulfing. You look to be a what? A buyer when price comes back to the candle that has engulfed the demand. So it rallies away. When it comes back, you look to be a what? Buyer. So that's how you use the engulfing pattern to take some trades. But in most cases now, what you need to know or what you need to do, this has to be part of the confirmation list. Say you are doing your analysis, right? It has to be a confirmation criteria that you use to say, okay, I'm looking at this currency pair here, and price is trading at a higher time frame, demand zone or supply zone. Do I have a morning star there, or do I have an evening star? Do I have a bearish engulf, or do I have a bullish engulf somewhere in that price action? You see, so you use it to confirm your trades. You see, the patterns help you to confirm your trades so that you just don't go in with a blind eye. You just don't jump into the market without any confirmation that you would have had on the trade that you want to take. You see, so these are like confirmation patterns that you have to use as a trader, not to just go in blindly. You just get into a trade and then you don't know what's really happening in the market. So I hope you've understood perfectly what I just said.
Yes, sir.
Yeah. So I think that brings us to the end of our class today. It's going to be a short one, 40 minutes, because I'm still not 100% also myself, but I just had to make time for you.
Okay, sir, no problem.
Yeah. So I did record the session. I'm going to upload it, and I'm also going to send you the notes of the class that we did. Yeah. And then I think tomorrow, if I also do get time, but otherwise it will be Wednesday. If I do get time tomorrow, then we are going to talk about the fresh and the original demand or supply zones. That's the topic for our next class.
Okay, sir.
Yeah. I don't know if you have any questions.
I will ask when I have questions.
Yeah, but
about a few weeks back, we talked about that gap in the market.
Yes.
Yes. But now, why do they say now do weekly trades or monthly trades? So that I don't understand.
Sorry, repeat that.
The monthly trades and the weekly trades. So you like leave it, or do you close it, or what do you do in that situation?
No, you see now the thing is, normally I don't advise people to hold trades for long because I'm a day trader. I look to trade maybe 2-3 days in a trade and then I close it, especially over the
Oh, okay.
weekend. You see, over the weekend, you are putting yourself at risk of the market gapping, right? So it can either gap to the upside or it can gap to the downside. So, for instance, if you
Yes.
are in a long position and then the market gaps to the downside, it means your trade is already negative by the time the market just
Okay.
opens. You see,
Okay.
that means you're gonna have to be patient. Like for instance, see Euro GBP today. Today is Monday, right?
Okay.
Look at today's price action on Euro GBP, especially the opening price. You see where the opening price is
Okay.
and Friday's closing price.
Okay.
It means market opened with a gap. Can you see that?
Okay. Yes. Yes.
Right. I'm gonna highlight the opening price of today and the closing price of Friday. So the market opened here. Let me just highlight this quickly. So the market opened here, but on Friday it closed above here, right? That's where the market closed. Now I'm gonna go on to a lower time frame for you to see the gap properly. It means whoever was in a long positions, when the market opened, there was a gap to the downside, and if their stop loss was within that gap, it means they were instantly taken out.
Okay.
You see? So now I've highlighted the upper line represents Friday's close, and the lower line represents Monday's opening price. Now I'm going to go on to an hourly chart. So this is an hourly chart on Euro GBP. Now I'm going to put
Okay.
my daily dividers, Control Y. So this is today's price action, and the previous bar is Friday's price action.
Friday.
Now I'm going,
Okay. Yeah.
right. Can you see where the gap is?
Yeah. I see the gap. Yeah.
Here.
Yeah.
So it
True.
means if you had a long position when market closed here, right, and you had a stop loss here, when the market opened down here, your trade closed automatically.
Okay.
You see? But now
Okay.
the thing with the gaps, one thing that you have to understand with the gaps, they eventually fill out. As in the gap is closed. Eventually. Some people they only trade gaps. You see? Like whoever was awake, a person who trades gaps, when they saw Euro GBP opening with a gap to the downside, the moment the market opened, some people would have already opened long trades here, right? Because they knew that eventually this gap is going to be closed, which eventually happened here.
Okay. See.
You see?
Okay.
So if you open the long position on Euro GBP when the market opened, yeah, of course it's gonna be expensive because the spread is gonna be too high. But if you opened that trade and then you hold it all the way into London session, eventually the gap closed
Close.
and then the market rallied to the upside. But the dangers now are always that what if you're on the wrong side, you see? So it's things that you
Yeah.
just have to put into consideration yourself as a trader. There's the gap here, you see? So
Yeah. I
eventually,
see it. Yeah.
yeah, this is the gap. got this last green candle here, and then this green candle. Between those two, there was a gap, and it opened with a gap within those first 30 minutes. It closed the gap. Can you see?
Yeah.
So this is like it usually happens. Is in the market. Market can gap out. Market can jump. Some they like to call it a jump. Some they say a gap. So it usually happens, especially on Monday, on the first day of a trading week. This usually happens. You can see here on this is CHF JPY. The market gapped to the upside. You can see on the weekly. You see Friday's close is below, but today's open is higher. It means it gapped to the upside and eventually closed that gap and traded lower. So it's just a case of understanding what the gap means, you see, and where is the price at that moment. Sometimes a gap can open and never to be closed, to only close like maybe after a long time. You see, you just have to go onto your charts, you read the charts, and then you see that there are some gaps that just open, but market does not come back there in a while, to only come back maybe after like 5 weeks, 6 weeks, you see, after opening with a gap. You see, like here on this is USD JPY. You see, market opened with this gap here. Let me see. Where's my drawing to? Right? Market opened with a gap here. Come on, where are you? You see here? You see that gap?
Okay.
Yeah, eventually it traded lower and closed the gap, but that was a very big gap. I'd like to see if there's any which hasn't been closed. Anyway, be that as it may, I don't think there's any gap. Right, you see there? You see this one?
Yes, sir.
You see here? There. There's a gap between this candle and this candle.
Okay, see there.
And that this gap only closed here. Now this is a weekly time frame.
Okay.
That means it took, so if it's a weekly, so this was May 2019, the gap only closed February 2020. See?
Okay.
So it took like 1 year to close this gap.
This gap, okay.
Yeah, so you must always look at a gap in relation to where the market is. If the gap happens at a demand zone, then expect that gap to close and then market rallies to the upside. If the gap happens at a supply zone, expect the gap to be closed and then price drops to the downside.
Thank you for clearing that up.
All right, my brother. Is there any more questions?
Thank you, sir. Not at the moment, sir.
All right, my brother. Have a great evening.
Okay, you too. Thank you very much, sir.
All right, cheers.
Okay, bye.
Bye-bye.